Welcome to KNN. KNN is brought to you by Bob Knakal, Chairman of New York Investment Sales at JLL.
Hi, I'm Jon Hageman, Managing Director at JLL. Welcome to KNN. Today I'm here with Bob Knakal, Chairman of New York Investment Sales at JLL. And today we're going to talk about the first half 2019 investment sales numbers. So Bob, the first half numbers are in now that the second quarter is behind us. Usually when we start these talks, we look back historically of where we were recently and what our expectations were going into the year. Why don't you shed some light on what we've seen so far?
Sure, Hags. Coming into this year, our perspective was very different and our expectations were very different than what has transpired. And so, as you know, as you said, I like to go back and give a little historical frame of reference. Cyclical peak in terms of the volume of sales clearly in 2014 and 2015. For the broader market, there were more buildings sold in 2014 than ever before in history. The dollar volume was the highest in 2015. If you look just at investment sales over $10 million, both the dollar volume and the number of properties sold peaked in 2015. Starting at the beginning of the fourth quarter of 2015, we started to sense a change in the market. We knew things were different. We saw disruptions in the land market, disruptions in the hotel market. And so coming into 2019, we were hoping there'd be some kind of a change in the market because this correcting phase of the market that we've been in had been for 39 months already. So that's relatively long, and most of these corrections last about 3 to 4 years. And 2018 showed some very positive signs.
You mentioned positive signs we saw in 2018. What was it that made you think it was going to continue into 2019?
Well, in 2018, we started the volume of sales start to pick up. We had a nice increase in volume from 2017. Normally, volume moves before values move. So coming into this year, we said we're 39 months into a correction. We had volume of sales start to increase in terms of dollar volume in 2018. Normally what that would do, that dollar volume would start to pull value up with it. We'd start to turn around. And so coming into this year, we expected not only would dollar volume continue to increase, but that the number of properties sold would increase, and those would naturally pull value up with them. But that wasn't what happened.
So Bob, what have we seen now that we're through the first 6 months of the year?
Well, in terms of the dollar volume of sales, and again, this is for investment sale transactions over 10 million, we had about $10.2 billion of sales activity in the first half. Annualizing that, it was about 20.44 for the year, which would be about 23% below where it was last year. And if we look at comparing that 20.44 billion to the peak, that would be 63% below the $57.8 billion of volume that we had in that year.
So Bob, in one of your most recent Commercial Observer articles, you drew a comparison to what we're seeing in 2019 to a year previously in the investment sales market that wasn't so positive for New York. Tell the viewers what that was.
Yeah, Hags. The year I wrote about in that story was a year in which things weren't so great, and that was 2010. It wasn't nearly as bad as 2008 and 2009 at the real depths of the Great Recession, but in 2010 we just started to pull out of it. Things started to get marginally better, and if the pace of sales continues on the pace it's on today for the entire year, we're going to be just slightly above where we were in 2010. So it will be the lowest total going back 9 years, which isn't making us feel so great, but it is what it is.
So Bob, staying with dollar volume, why don't you dive into some of the specific product types that we track and tell us how they've been performing?
Sure. Well, a couple of them have been doing relatively well. The office building sector has also seen robust activity. That pace is up about 10%. The other product types haven't performed so well. If we look at those, we see that in the retail sector, we're on pace to be down about 40% from where we were last year. And not surprisingly, given what's happened with the multifamily sector and the new rent laws and the anticipation leading up to the new rent laws, we've seen a 55% drop in the volume of sales in the multifamily space. And the sector that's been hit the hardest has been the land sector, in which we've seen a reduction of 82% in the dollar volume of sales in that sector.
Bob, that's dollar volume. What about number of properties sold?
Okay, Hags. Well, if the dollar volume numbers got you upset, the number of properties sold isn't going to make you feel much better. For investment sales over $10 million, In the first half of the year, there were 80 trades, so annualized 160. If we keep on that pace for the year, we're going to see that the number of properties sold will be down 31% from last year's 232 sales, and would also be on pace to be about 65% below the 450 sales that we had at the peak of the market in 2015.
We talked about 2010 for dollar volume. How does it compare to 2010 for number of properties sold?
Well, it also would be, if we hit the 160 sold mark, that's also going to be the lowest total since 2010. There were 117 trades over $10 million in 2010. This would be significantly above that, but yet the lowest total since 2010. So that 2010 thing is coming back to us again and is really indicative of the type of overall activity we've seen in the marketplace.
Bob, what about now number of sales within those product types that we mentioned already?
You know, within the product types in terms of number, the office sector is the only one. The number of trades actually is increased. The office building sales are up about 8% from where they were the prior year. All the other sectors are down, as you could imagine, with the big drops that we've had. But I think the message is it's important to realize that the market always has been, is, and always will be a cyclical market. The market's in a little bit of a funk, which is kind of hard to understand given how well the traction is in the broader economy. There are so many factors in the economy that are doing well. It's remarkable that the New York investment sales market hasn't been benefiting from that. But, you know, we do expect that after we get through this multifamily disruption, the other product types seem like they're poised to start doing better. But, you know, we'll have to see how that market's going to play out. But because of the cyclicality of the market, we think we have to be pulling out of this at some point in the not too distant future. And so we're optimistic about that.